What's going on, YouTube? This is YB or Dong. I'm not a financial advisor, but hey, subscribe to my video, and I'm gonna go over what's a mutual fund, what's an ETF, what's an index, which one's right for you, and show you the difference by picking three random stocks, ETF, index, mutual fund, whatever you want to call it. And let's get into this video. So, first of all, I'm going to go into the definition or what each one is. And then I'm going to go into the pros and cons of each one. And I'll put on the screen the key difference after that. And then lastly, I will go into comparison and see which one I personally pick because of what I seen with the numbers. So the definition of a mutual fund. A mutual fund is just a pool of money from multiple investors to invest in diverse portfolio of stocks, bonds, or other assets. Now, the biggest thing about this, it's an active managed fund account to outperform the indexes, ETF, the stocks. This is their whole goal, and it's actively managed. Now, mutual fund shares are purchased or sold at the end of the day of net asset value NAV. So they often have minimal investment requiring higher expense ratio compared to ETF and index fund. So that's a mutual fund. In hindsight, what is it? It's an active managed account that has a possibility to outperform the ETFs and index fund. Has a possibility. But on the screen, this is how many active managed fund actually outperform the indexes. Crazy, right? Now, let's move into the definition of ETF or exchange traded funds. ETFs are traded on stock exchange like it's a individual stock. So you can buy and sell them throughout the day, and it's just a normal stock to most people. But here's the thing. Most ETFs are passively managed and track an index through some type of active management. So semi-active, they try to track the indexes and make minor changes to keep up with it or do better than it. But ETFs generally have lower expense ratio than mutual fund and offer higher liquidity and tax efficiency. That's what you need to understand. ETFs is good for tax efficiency. They are suitable for investor who wants to in trade days, trading flexible and low cost. All right, that's ETF. Now, let's go into the index funds. Now, what is an index fund? Index funds are a type of mutual fund or ETF designed to replicate or perform of a specific market index, such as the S&P 500. They're passively managed, meaning that the simple holding has the same security and the same proportion in the index. So like the top 500 companies, you have oil and gas indexes. It just copies it just has a group of them together, and it's more of a set it and forget it type of investment. Now, on the screen, I'm going to show you the key differences of each one. So if you look on the screen, management, mutual funds active or can be passive. ETFs, they're mostly passive, some are active. An index fund is a passive, completely passive. Now, trading, key difference. Mutual funds, end of the day. ETFs, throughout trading day. And index funds, it depends on the structure. It can follow mutual funds or the ETF. So it varies on which index you buy. Now, let's look at the expense ratio. Mutual fund has a higher expense ratio. ETFs and index funds has a low. And those are the key differences you need to know. Now, before I tell you which one is my personal opinion, go into the pros and cons, let's talk about choosing the right one for you. So if you choose a mutual fund, you prefer professional management and are willing to pay higher fee for the active strategy. That's what a mutual fund is. You're willing to pay someone, you're betting on them that they'll do better than the market. And if you choose an ETF, you want a lower fee. You want tax efficiency and the ability to trade throughout the day. Now, if you choose an index fund, you prefer passive investment with minimum fees and want to return closely or follow the market index. Now, the big thing is you need to understand the difference between each one. If you align to choose investment goals, risk, tolerate, and trading preference, and that's why, or then that will help you figure out which one's best for you. Now, let's go into the pros and cons of a mutual funds. Pros of a mutual fund: it's diversified. The second part is professionally managed, so you can experience fund management, handle research, asset allocation, investing decision to be able to maximize your money. 3, liquidity. Open-ended mutual funds can be bought and sold easily, and that's a good part about. Number 4 is low barrier entry. You can invest in mutual funds with very little money. 5, the systematic investment plan. Regular investors help reduce market volatility through rupee cost averaging and encourage disciplined investment. And number 6, tax. Certain mutual funds like ELSS in India offer tax deduction under Section 80C. And long-term capital gain may be tax-free up to a limit. So those are some of the advantage, and there is a convenience and flexibility of mutual funds. Simple investment combined with mutual security into one investment. But let's talk about the disadvantage. So here's some of the big disadvantages. You're at market risk. Returns are subject to the market fluctuation. That's the thing about mutual fund. There's no guarantee of profits. There's no guarantee that it'll do well. It's actively managed and you're trusting someone to do this. Number 2, the fees and expense ratio is the highest between the 3. So no matter what, if it does good or bad, guess what's going to happen? You're going to have to pay that fee. Number 3, potential tax implication. Dividend and capital gains are generally taxable even if reinvested, which can affect net return. Understand that. Number 4 is lock-in period. Some funds like ELSS or closed-end funds have mandatory lock-in period, which limit liquidity. And performance variability. Not all mutual funds perform the same. It depends on your manager and their skills. A lot of them don't do so well. Like I said, 81% of active managed fund hasn't been able to beat the index. And number 6, your limited control. And those are the cons of mutual funds. So now we know the pros and cons of mutual funds. Let's go to the pros and cons of ETF. Pros and cons of ETF. So the first pro is cost efficient. ETF typically have lower expense ratio compared to mutual funds. So it makes it more cost efficient for investors. The second pro, diversification. ETFs have very good diversification. Number 3, real-time trading. Let's say you buy something, you accidentally didn't want to buy that ETF. You're not locked in for that day. You can sell it immediately. So ETF can be traded throughout the day and offer flexibility for long-term buy and hold and short-term swings. So you could day trade ETFs. I don't recommend it, but hey, it's a possibility. And the biggest part of ETF is tax efficiency. ETFs are generally more tax efficient than mutual funds, often limiting capital gain distribution. Now, since we talked about the pros, let's talk about the cons. Market risk. Is subjected to the market. So if the market does bad, ETF does very bad. Tracking error. ETFs may not perfectly mirror the index and volatile market could cause it to drop in pricing. liquidating gap. Not all ETF trades heavily. Even though you can trade that out throughout the day, doesn't mean someone's there to purchase the stock from you. You have to remember, even if you press sell, someone has to buy the stock. And it could be a big gap of what you want to sell it for and what it's actually selling for. And lastly, tax consideration. While generally it's tax efficient, capital gain can still pop up if the fund manager rebalance or if you sell for profit. So if your fund manager goes in there and sell a bunch of things and rebalance your portfolio, guess what's going to happen? You might get hit with a capital gain tax at the end of the year and that you didn't know of. So those are the cons of ETF. Now, last one is index funds. Index funds. Let's talk about the pros and cons about it real quick. Low fees, simplification, diversification, and tax efficiency. Those are the pros for it. Now, we have to talk about the cons. Limited upside. Index funds designed to match, not beat. So if you're trying to beat the market, index funds aren't designed to beat the market. It's just to follow. The second issue is the market exposure. You can still lose money in downturns as an index fund to the entire market. There's tracking errors in index. And lastly, you have less control. You can't dodge sectors or stocks the fund owns, which may not be suited for all investors. Maybe you don't like XYZ stock in this index fund. Well, you have no say in it. You buy the stock, the index, and that's what you get stuck with. So let's do a comparison of how a mutual fund has done over the years and how has the index and ETF have been done. And we're going to look at the expense ratio on each one and see the differences see how well they did. And these are just the random ones I picked. I didn't do no research. So here's American Fund Washington Mutual Fund Index. And let's compare it. Year to date is 3.07, 1 year 16.34%, 3 years is 27.73%, and 3 years is 30.15. So the 1 and 3 years look pretty good. You know, you got decent returns. And you got an expense ratio of 0.55%, which I think is pretty high to pay for buying a mutual fund. But there are ones that are 1%, there are ones that are 2%, and this is where you have to watch out because the expense ratio. Now, 1 year return is 16.34%. Let's compare this to an index. And I just picked Vanguard 500 Index Fund ETF VOO. So, same thing, year to date, up 3.79%. 1 year, up to 17.28%. And if we compare it, the index beat the mutual fund. And if we compare the 3 years, what would you rather have, 69.93% or 27.73%? And the big factor is expense ratio is 0.03%. And if you compare it to the expense ratio of 0.55%, you're paying 5.3 or 5.2% more in expense ratio to have that account. And the 1 year return is 17.2%. So for me, if I look at these numbers like this, because numbers don't lie, Vanguard ETF VOO has outperformed American Fund Washington Mutual Fund. So why would I want to pay more for active managed account? Now, there is a mutual fund that has outperformed it, but remember, I just picked a random one, and the expense ratio is 0.03% with a 17% 1 year return. And lastly, let's compare the Vanguard Index Fund to Fidelity 500 Index Fund or ETF to index. So right off the bat, the 1 year return is 17.46%, 17.2%. So the 1 year return for Fidelity 500 index beat the ETF. And if you compare the expense ratio, 0.02% compared to 0.03%, that's a 0.01% higher fee for that ETF. And if we compare the 5 years to the 5 years here, 80.49% compared to 81.52%. So which one done better? Fidelity 500 index. Now, which one would you pick? Personally, if I'm looking at this number, I want as low as expense ratio I can get. If I'm going to pay a management fee, they have to outperform the index fund. So this is how I look at it. Now, I personally recommend you buy index funds if you're a beginner investor, because just look at these numbers. Which one did better? The Fidelity 500 index overall. So like and subscribe to my video. That's all I got for you. Hopefully that helps you understand what's mutual fund, what's an index, what's a ETF, and which one you should buy based off the information I gave you.